Hi, I'm Keith McCullough. Welcome back. Today I want to talk about Japan. I'm here with Darius Dale, who's the senior analyst on our macro team, who covers all things Asia, Latin America, etc. And Japan's been a big topic of his. I think it should be a big topic of yours because the Nikkei is already down 5.3% for the year to date. So we want to talk about that, their currency, expectations on both growth and inflation specifically. So Darius, let's just kind of get into the first part, which is growth. Expectations in Japan have to be elevated. Do you think that they can deliver on growth?
Actually, no, Keith. In the first quarter, we actually expect Japanese growth to slow, and we expect it to continue slowing throughout the first half of 2014. If you look at where Japanese growth has been in the current chart, this is our GIP model, stands for growth, inflation, and policy. You've seen Japanese growth has been on an absolute tear. Everything's above the horizontal axis, which is growth accelerating. And we think it could go from quad 2, which is a phase of growth accelerating and inflation accelerating, down to quad 3, which is growth slowing as inflation accelerates.
Mm-hmm. And for those of you who are watching this at home, you could see by quad, Darius means in the 4 quadrants that we show. Our model, really our GIP model that he cited, our growth inflation policy model, we're trying to find growth and inflation. Where are you? So again, we've gone to the second quadrant, which is obviously very, very bullish for Japan. And as you go to the third quadrant, that would not be a good thing. So on the second part there, Darius, on inflation. Now this is one of the hardest things for people to monitor or to understand. How do you look at it in Japan?
Absolutely. So you really have to separate reported inflation versus inflation expectations in Japan.
Which are very different things, because the government can state inflation at whatever they want.
Totally. So we think inflation on a reported basis is going to continue to creep higher over the intermediate term. But what really matters to the currency and de facto the equity market is inflation expectations. So if you look at the scatter chart, we chart 5-year break-even rates, which is essentially the spread between nominal yields on that tenor versus the yields on inflation-linked securities. And what you've seen over the past 3 years is that 5-year break-even rates have had a positive 0.85 correlation to the U.S. dollar Japanese yen rate.
Which is a huge correlation.
Absolutely.
Any correlation above 0.7 is big. 0.85 to 0.9 is huge. Now, break-evens, can you just kind of like simplify that a little bit more? Why do people care so much? Market people, because it's different than government people. Why do market people care about break-evens?
Absolutely. So break-evens is one of the most clean-cut measures of inflation expectations out there. And inflation expectations, obviously, with the chart we just showed, really matter to the Japanese yen. And typically in Japan, what you see is that break-evens or inflation expectations will track the slope of growth expectations lower or higher over the intermediate term. So our call for growth to slow over the intermediate term might pose a threat to Japanese break-even rates.
That's interesting. And as Darius, a very astute analyst, one of our best here, he talks about the slope of the line, so the rate of change. So when he's talking about growth, the growth expectations and inflation expectations can be doing different things at the same time. So again, you have to watch expectations, not what the governments talk about, and that's a very important point. So if you look at, like, to your point, a 0.97 correlation, basically this says if you want to get the Nikkei right or you want to get Japanese stocks right, you just got to get the yen right.
Absolutely. It's a call we've been making since fourth quarter 2012. It's a call we've continued to make. I don't see any reason to change until the math tells us to.
Now, to get the currency right, to get the yen right, we have to get the final point in the GIP model, or the P, the policy part. What is Kuroda most likely to do to that currency?
Well, so if you backtrack, Kuroda is interesting because if this was Masaaki Shirakawa running the BOJ still, who was the former Bank of Japan governor, we'd say inflation expectations tick down with growth because he was not dovish enough.
So the market didn't deem him credible.
No.
The market didn't believe that Shirakawa would burn his currency at the stake. But you're saying
Kuroda is a different story.
Really?
Kuroda is significantly more aggressive on the monetary easing front, has been over the past sort of 9 to 12 months. And so if we think about what the market is expecting Kuroda to do, which is ease more, particularly as the consumption tax hike is hiked in the second quarter, we think they might actually start to pull forward expectations of the Bank of Japan easing further.
That's
from
his
here.
lever. It's almost exactly like Ben Bernanke in 2011.
Totally. The market might start to cheer on bad data like we saw in the U.S.
Because as long as the yen burns, perversely, the people, by the way, you get purchasing power starts to erode, you get inflation going up at too fast of a rate. Perversely, you could still see the Nikkei go up.
Totally. That's what we've seen in the U.S. for quite a while now, up until 2013 started. And that's something that could happen in Japan, which would be a major bifurcation from how the Japanese yen and Japanese equities have traded historically.
So in terms of levels, just to put kind of like a bow on this, I want to look at two different things. I want to look at both the yen, and I want to look, because a lot of people trade the yen, obviously,
Yep.
and I want to look at Japanese equities.
Yep.
What we're looking at here on the first chart is the dollar versus the yen. Why do we use that?
We use the dollar yen because it's the primary indicator for yen strength or weakness. As you know, Keith, the correlation's very tight, so we're constantly ball hawking your levels, your quantitative signals on where the yen could go from here as it relates to Japanese equities.
And to be clear, we wouldn't use that if it didn't have a 0.97 correlation.
Absolutely.
It makes our job a little bit easier.
Much easier.
So that's an interesting chart, and you could see that really at the beginning of the year. The yen, almost shockingly to a lot of people, is up 2% for the year to date. So
totally.
that's why the Nikkei is down 5%. Get the Nikkei right and the yen right. That typically happens at the same time. Now, looking at the Nikkei, what are you seeing here?
I'm seeing a market that's obviously correcting.
Yeah.
It's intermediate term trade broken. Is that going to confirm itself? I'm not sure. We have to sort of give it some time to breathe. But to the extent that does confirm itself, that might be the first signal that the yen might actually start to break down.
That's interesting.
Perversely.
Yeah.
However, that's not something we anticipate. Again, I think the market is expecting Kuroda to be more dovish, and our view is that Kuroda will come in and step in on a proactive basis to ease monetary policy, which is what the market expects if you look at the futures and options position in the currency
Which is
market.
a huge position.
Still one of the biggest net short position in the futures and options market today.
Which is saying something.
Absolutely.
Suffice to say. So again, if you look at this chart, this is our intermediate term trend line of support. That's the real line here that most likely matters to Darius, which is 15,045 on the Nikkei. Provided that holds, you expect your scenario to play out.
Absolutely, absolutely. But this is the first time in terms of thinking about this trade, the quote-unquote Abenomics trade, where we're saying, hey, don't necessarily add to positions on weakness. Give it some pause, let these levels test themselves and hold before you do anything else.
Which is very interesting, because it's the first time you've said this to me in like 2 years.
Absolutely.
So that matters. That's why we're talking to you about this today.
Absolutely.
So that's great. Thanks for putting that all together.
Yep.
That's how we think about macro. We don't tell the market what to do. The market tells us what to do. So again, we start with history, do a lot of math. So again, Darius will talk about correlations between currencies and stock markets and policies. And again, we certainly consider the behavioral aspect of the trade. So don't forget, a lot of people are short the yen. Yep. So with all that considered, if you have any questions, again, ping me. @Keith McCullough is my Twitter handle. You can also find Darius Dale. His Twitter handle is right there on the screen for you as well.